What's happening, everybody? It's the Silver Fox here. Welcome to the Silver Fox Den. Jerome Powell has done it. He has raised rates 0.25% to avoid them looking like they broke the system. And they're going to break the system by raising the interest rates on the banks. I did watch the press conference. I don't have a whole lot to say regarding that. I will say I was going to come up with a video yesterday. I didn't have enough time, but I kind of was thinking he was going to do 0.25 just to make it look like, everything's still good. Everything is on the up and up, and we're going to kill this inflation. And I think he said a couple times, keep it to 2% is their goal. I think we could all agree, even though the rates they say is around 6 or 7%, CPI, Consumer Price Index, I'd probably say it's like 15, 20%, when you take in housing and buying a car and food, which isn't calculated in their price. Um, but I guess to talk about the rate increase, so 0.25, that's kind of what I was expecting. So it's going to raise um, rates on the banks, and when you raise rates, then their bonds and their securities are worth less, is how I understand it. And so when everything was good and dandy and things were like 0 or negative % interest rates, the last couple of years, their bonds were worth a lot of money. And the funny thing is, the bank should have realized that eventually the Fed's going to have to raise rates, and that makes their bonds worth less. I know it's kind of hard to understand, but basically, when they raise rates, bank bonds and their borrowing cost more, and their assets are worth less. Their bonds and treasuries and stuff when rates go up. When they raise rates, also cryptocurrency, gold, silver, precious metals also go on the decrease as well. So you kind of have to think about it that way. And borrowing costs for consumers, if you have an adjustable rate mortgage, or I have one student loan that's variable, and it has the least amount of money on it. I think we'll probably pay it off pretty soon. Otherwise, so I do feel the increase of that. Long story about that, but so I do have one adjustable rate student loan, which is kind of stupid, I know, but there's a reason for it. And your auto loans are going to go up if it's adjustable. I think most people do fixed. Um, but if you end up trying to buy a house now or an automobile, you're just going to keep seeing those rates increased off of what they were. And usually the banks have it priced in before the meeting. They have kind of an inside scoop on what's going to happen, and or they guess and they price in ahead of time. That's kind of what we saw when we were trying to buy a house and the interest rates were going up. Was like a week before the meeting, the rates would, go up, go down, mostly go up. So all that's interconnected. But through his briefing and question and answer with the press, his goal was 2% inflation, and with however many billions of dollars that they're doing this, I forget the exact word or terminology, but like a side exchange bank where the banks could trade in their bonds or treasuries for what they're worth in their maturity rate, and them getting the full amount, and then the FDIC not telling anybody what bank that was, um, and that's good for a year. I think that's only going to create inflation, and insuring all the money with Silicon Valley Bank and the whole debacle with Signature, and then all those big banks backing up what was it, First Republic. That's just more money creation, in my opinion. And I don't see that as helping inflation. I think the banking policy of the Treasury is actually creating inflation and raising rates. Granted, 0.25 isn't a whole lot, but I feel like raising rates is making the banks worse, which then they get bailed out and then increases inflation because when the banks go under, the money doesn't disappear. They get twice the amount of money to cover all the losses. So it doesn't make a whole lot of sense. I don't think it should make sense at this point. But I think we can only assume that things are going to get more expensive. If you have, a car repair or like we have some windows that need to get fixed, you probably want to do that sooner than later, just based off of bank lending costs affect a lot of commercial businesses. And to get products, like big box stores, they take in credit or they take credit to them buy the product and they flip it for, like usually at a grocery store or something, they're buying things for $1, selling it for $2, is or maybe two or three times what they buy it for. But that money takes capital to get and then put in the store. So you can see kind of down the line, things are only going to cost more. And helping all these banks out and stuff and insuring every single bank account, it's just going to get out of hand, in my opinion. Um, so that's basically what was said during the meeting. He also talked about job employment numbers being high and unemployment was low, like 3%. And there's not enough workers for jobs. I don't think that's exactly true either. If there's any jobs open, they're probably the lower level jobs, and then people have to buy or get three jobs to support them from their one job that they used to have, and so that makes it look like three people got hired, but really not. So, in conclusion, guys, the Fed today, 0.25, that's kind of what I thought they would do. They're helping out the banks, printing a bunch of money, covering them, backstopping them. And there's no money disappearing, it's only being created. So there's inflation there on the backside. And they're raising rates. So that's only going to create more inflation to borrow. So there's that. Stay tuned if you're looking for a car. I have a car video coming out on buying a brand new car and also why it might affect the used car market. So stay tuned. We'll see you guys. Hang in there. I know. We're all here together, huh? See ya.